Like to check so we can say good morning still, right? So good morning, everyone.
Good morning.
I want to say thank you very much for joining us for this inaugural event for the lecture series. This is going to be an ongoing thing that we plan to keep doing. Mr. Sam Govia has put a lot of work into coordinating this, and we are going to continue to do this because we have some really interesting topics. And I want to thank our speaker for today, Ms. Melissa Miller. Thank you so much for joining us. We appreciate you spending your time with us to share your insights. I think everyone could make use of making your money go further, especially, I'm borrowing your title, especially in this tough economy.
Yes.
So we appreciate your presence. We promise this is going to become an ongoing thing, and we have an exciting set of speakers. Every month? We have October 7th, we have another event. We have another one on the 22nd. And on Tuesday, November 11th, we have a variety of interesting speakers, and we are really looking forward to the impact this is going to have on our students, staff, and community. Thank you very much for joining us.
Yeah, of course. You're very welcome. Well, I'll get us started. So my name is Melissa Miller. I'm a financial advisor or wealth manager at Edward Jones. And I'm going to go through a few slides up here, but when I speak, I like to interact with the group. And so as we go along, if you have questions, please ask. That's the whole point of you being here. If you have questions, I want to make sure you get your answers. So I first got into financial services over 25 years ago. So hence all the gray hair. But honestly, it was because I came from a very humble background. There was 8 of us, and my mom and dad lived paycheck to paycheck. My mom worked 3 jobs. My dad worked 2 jobs. And it was just very difficult. And so I knew early on, I was like, there's just got to be a better way. And then my dad and mom, they wanted to teach me. They just didn't know how to do it themselves. A lot of times what I'm going to teach you isn't taught in school, or it's not taught consistently. So you might take one class and you forget about it, right? And so I know these tools work because frankly, I've used them. I know what it looks like to live with very little. And I know what it looks like to live with a lot. We have used these tools not only in my family, but I've helped thousands of families get into a better position to be financially sound. And the way I work with clients, and really anyone at Edward Jones, is we want to give peace and confidence about your financial future. And we do that by being your advocate so that you can make smart financial decisions. As a wealth manager, it's my job to partner with my clients to make sure that they can make good, sound financial decisions, and we build tailored strategies towards what you specifically want or what you're going through, okay? But it all starts with making your dollar go further and money management, which is what we're going to talk about today, okay? So simplify your spending and saving strategies. This will go right along with the topic. At Edward Jones, we have an established process. It's the wheel that you see behind me. It's where are you? Where do you want to be? Can you actually get there with what you're doing financially? Well, how do you get there? So that's like types of strategies, types of accounts, types of investments. And then step 5 is well, how do you stay on track? So it's super easy sometimes to get started, but then life happens, a life event comes in the way, and you're like, oh my gosh, I'm off track, how do I catch up, right? We only make so much, and so how do you strategically use your income to make sure that you're able to achieve the goals that you want to achieve? And so I personally don't just talk about retirement planning. There's all sorts of goals that you can do financially, and that we'll talk through a few of those today, okay? Oops. So step 1 is budget. So budget can be a 4-letter word these days. It's just the basics. You have to know how much money you're making, and you have to know what you're spending it on, right? I tell everyone that you need to make sure that every dollar that comes into your checking account, it's earmarked for something, right? And so when you're looking at your budget worksheet, you should have a packet in front of you, and in that packet you'll see a budget worksheet. Now, there's all sorts of apps out there these days. What I would tell you is that if you're struggling with really understanding your money, start with the pen and paper. Because whenever you write something down, for whatever reason, your brain connects with it far more than putting in an app or into a spreadsheet. Now, if you've been doing this for years and you've got a really good handle on your budget, then use whatever's easier for you, because whatever's easier for you is what you're going to do, right? And the whole point is understanding what that looks like. But when we're looking at your budget, I just want to kind of walk through this. Everyone should have it in front of them. I don't know that Sam put it up there. Do you know if that's on the screen, the budget? I don't think there's an extra one there, but for the folks that are online. Yeah. I know everyone in the room does. I'm just not sure if the online folks do. So when you're looking at the monthly budget, what you want to do is you want to always start with your income. And when it says, gross versus net, gross is what you make before anything's taken out. Net is after everything's taken out. So sometimes you'll have taxes taken out. Sometimes if you're putting in like 401k deductions, that will get taken out. But it's basically what's your full dollar amount you're making is your gross. And then you'll take out your net. And that's what you're going to see on this worksheet in front of you, in case whenever you get a chance to pull it up.
Do you need that up there?
If that's easy, that might be easier. So when you're looking at that, again, you want to put all your streams of income. It could be Social Security, it could be paycheck, it could be multiple jobs, like whatever that is, you have to fill in all your income. That's what you're going to see in this first income source section, okay? Your next piece is going to be like housing and utilities and all those types of things. And I always will give a budget worksheet to my clients regardless of whether they feel like they have a budget or not, because sometimes you'll see things listed on the sheet, they're like, oh, I forgot about that, I do pay for that. We have a habit these days to put everything on our credit cards, or we swipe a lot, right? And so if we look up at the end of the month, they're like, oh yeah, I do have that subscription. Or like with me, I have 4 kids and six grandkids, and they're always subscribing to something. And I'm like, that's not free. In 30 days, it'll be charging, right? And so whenever you're looking at your budget, you want to pull up all your credit card statements, all of your checking accounts, savings accounts, and you're going to go through itemized one by one to make sure you understand everything you're spending on. And then you're going to put them in these categories, right? So whether it's property taxes, you have gas, electricity, phone, water, trash, recycling, sewer, like all that stuff. And there's going to be a list of everything that potentially a household could have. What I would say is we've got quite a few people that are moving into Texas from outside of Texas. If you haven't homesteaded, please do that. Property taxes will creep up on you in a second if you own a home. If you're a senior, you should have a senior exemption. And if you're disabled, you can actually get an exemption for being disabled on your property taxes. That's a big one that will creep up on you, not just in your budgeting, but also in your planning when it comes to retirement planning. So I always like to call that one out. Is there a second page there? Oh, perfect. Okay. So then you're going to go in, and if you have insurance, you're going to put in all your insurance premiums. You'll put miscellaneous if you like to give to your church or nonprofits. Entertainment. So I'll carve that entertainment piece out. Whenever you're looking at everything you're spending, right, because you're putting together a budget, you want to leave some money for a buffer. Because inevitably we say, well, I spend $200 on going out to eat. But you're probably not accounting for it every single month. And so you just give yourself a little bit of breathing room, because you don't want to create a budget and then every time break it because you didn't give yourself some breathing room there, okay? So give yourself some grace. That's the first step, is going through all of your checking accounts, all of your credit cards, making sure you've itemized and just putting into each one of these. Now, once you take your income and you minus out all these expenses, at the very bottom, you'll see a discretionary. Go all the way down to the bottom for me. There we go. Discretionary, what we call disposable income. So you take your income minus your expenses is your discretionary, or what we call disposable. That extra amount at the end of the month is what you would put towards savings, pay down debt quicker, or into your investments. And depending on where you are, it may be a variety. You could put $100 a month into savings, $100 into your investments, or if you're trying to get out of debt, which we'll talk about here in a second, you might double down on your debt. So everyone's different. Everyone has a different life experience and what they've been through financially. So that's where having a conversation with someone might give you a better idea of like where to steer that extra money. Now, some of us may not have any extra money, right? And so that's when you go back up. If it's a negative, you want to go back up into your budget and say, okay, well, if I'm spending $400 or $500 on going out to eat, can I spend $200 next month? Right? You can't go cold turkey. This is for people will set themselves up for failure. Don't go from 500 to 0, because you're not gonna succeed. Go from like 500 to 350 or something. Get it comfortable and just kind of work yourself down. You should always leave some room for going out to eat, because frankly, this is America and that's what we do. Okay, be realistic. That's the point. So that's going to be super important. Is if it's negative, and look, some of you may have a really good handle, and sometimes you're going to be in a life stage where money comes in, it goes out, and there really is nothing to work down in the budget. If you own a home, you should shop your home insurance at least every 3 years. Normally in Texas, they're very competitive, and you can actually get better rates when it comes to home insurance. Now, cheaper when it comes to home insurance is not always better. I'm not saying that. You want to make sure your house is fully covered, right? But you also want to make sure that you're getting the best premium out there too. And so any type of insurance product, cars though, same thing. Shop it every 3 years. Again, cheaper isn't always better, but that's a way to kind of streamline some things. You want to make sure you're looking at all your subscriptions. And if you're not playing those games, get them off. right? Stop subscribing to the little $5. Like every dollar counts. Sometimes my clients will come in and say, Melissa, it's only $5. Every dollar counts. Because the 5 can turn into 10, the 10 can go into 15, 15 can go to 30. Like it can start increasing, and you can put that much more money into savings and that much more money into debt. If you can handle the little things, you're going to be able to handle the much larger wealth once you get there in the future. That's the key, okay? So that's budgeting. I'm going to pause there. Is there any questions on budgeting before we kind of jump to something different?
Can I make a comment?
Yeah, sure.
Eating out prices have really increased the last couple of months.
They sure have.
So when I was thinking I was spending budget-wise, and I said we usually spend about this much, I didn't realize until I looked at the receipts that I'm spending actually about 25% more than I was before. What was usually $30 for spaghetti is now $45 plus tip. It's like, wow, I didn't realize that. You just sign the thing. Right? You put the number down, you sign the thing, you forget.
Yep. Yeah, so it's called inflation, right? We hear that word a lot, but inflation, what that really means is everything gets a little bit expensive more, every year, over and over, right? And so inflation has come down a long way. So a couple years ago, inflation was over 9%. That was crazy. They had to pull it down. That's why you keep hearing all these conversations about interest rates. Where you're not seeing a pull down in inflation is in food, shelter. Gas has come down quite a bit, but there's still some sticky spots across the country. But your food and your shelter is really where you're not seeing differences in inflation. And frankly, that's where most people care about. Let's just be honest, right? But when you're talking about budgeting, back to his point, is you don't want to do this once and forget it, right? It's something you should do each month, every single month. And if you can get in that practice, you'll be better off for it. Now, if you've been doing this for years and you feel like you've got a really good handle, then I would tell you every 6 months. Because every 6 months, something's going to pop up. I'm like, oh, yeah, I forgot I subscribed to that. Or, oh, yeah, we are spending a little bit more money. But at Sam's point, we used to take our family out for $50, and now I'm spending $150. So it could be considerably higher. Yes, sir?
So what would be your advice to people who are about to move out from the parents' house and about to enter the world and, say, about to get an apartment, and how budgeting for someone who's probably low income and is probably still a college student?
Yeah, so, I would tell you to move where you can afford it. Sometimes, because I've got clients that are right out of college or still in college, and my oldest is 100 years old, right? And so I think sometimes when we start trying to get out on our own, we look at what everyone else has, and we're like, oh, well, they're living there, I can live there. It doesn't necessarily mean that, right? And so live within your means. And it doesn't matter if you're 21 or if you're 87, live within your means. Right?
I guess what I'm asking is more is what percentage of my income should I be putting in, say, like stuff like housing and food, things that have spiked over the last few years, compared to things that I might have needed to put more money into, like, say, tuition or, say, more want things?
Yeah, so I would say 80-20. There's a rule out there called 80-20, where 80% of your income should be spent on, like, your food, shelter, tuition, right? Because to me, college right now is a need. And then 20% is more for, like, savings, paying down debt, investments. If you can stick with that, 80-20 is a really good rule. There's a 50-30-20 you can get into, but 80-20 is a little bit simpler if you're starting out. Does it answer your question?
Kind of.
Okay. Yeah, you don't want to get to the point where every dollar that comes in is going out, right? And so you just want to make sure, especially around campuses, you're going to get much more economical apartments, et cetera, than if you're moving farther and farther away from campus. That's true too, okay? Roommates are great in college, or if you're still going to school. My son came to TCC, this campus, for a couple of years, and so he had a roommate right here close to college. So yeah, whenever you can share expenses is even better. Even if you're moving out from home, sharing expenses can be very helpful. Yeah. Yes, sir?
I was wondering, you're trying to budget to buy a house.
Sure.
I want to tack aggressively a down payment towards it.
Mm-hmm.
And is it wise to pay minimum on debt for now while I catch up and get a good down payment for a house since interest rates are going down?
Yeah. So the way the real estate market works is you're going to have to go and get approved for a loan, but they're going to look at your outstanding credit. And so if your debt to equity is messed up, meaning if you have too much debt according to your income, you may not get approved. So there's a balance. I would tell you to try to pay off, especially credit cards. Try to get those completely paid off. That's going to hurt you the most when it comes to mortgages usually. Actually, student loans, they don't hurt you as bad as like a credit card would when it comes to mortgage lending. And so, yeah, you should focus on paying down credit cards. If that's all done, then I would recommend talking to a mortgage broker. They can actually tell you, they can look at what you currently have as far as your debt's concerned, your income's concerned, and they can tell you, depending on how large of a house you want to buy, what your down payment could be. There's a lot of down payment assistance for new home buyers, so you can actually get and get a little bit more educated as far as what's out there. Veterans too, they have a lot of assistance programs out there.
Well, how about, I pay smart because I use my credit cards to pay for everything.
Mm-hmm.
At the end of the month, I just pay them off.
Sure.
And I just do that as a cycle
That's fine.
for my credit.
As long as you're not carrying balances, it's not going to hurt you.
So it's good to just keep.
If you're disciplined, yeah, and we'll go and get that into the debt side. Yeah, if you're disciplined and you can do it on your credit cards, great. If you're carrying balances, that's a problem because it'll end up hurting what interest rate you can get on your home, etc. Yes, sir.
So how familiar are you with the housing market? I'm just curious, unrelated to probably what we're talking about here, but where do you think in the future the most affordable new housing is going to be built?
It depends. Dallas-Fort Worth is hot. You've got a ton of people moving into the Metroplex. So I can't tell you I'm a real estate expert. What I can tell you is that my husband was in commercial real estate for over 20 years, and we own multiple properties. And so I would tell you that right now, I don't know that the demand in the DFW area is going to reduce because we have so many people. So again, talking to a mortgage broker is going to be super important. How big of a house are you looking for? They can actually tell you per county what has lower county taxes, school district taxes. If you're moving into Keller, I pay outrageous school district taxes. And so it really depends on which county you're in, which school district you're going to be involved with, but your mortgage broker can really help you. If you take down my card, I can send you some information. I can give you to a mortgage broker that can.
Being like a decade out from now.
Yeah, that's fine. Yeah. I would say if you're looking to buy a house, though, you need to start thinking about it, but 2 years. Give yourself 2 years because you're going to have to understand like what you can buy, what you can qualify, and then you have to start saving for the down payment. And that all kind of goes back to budgeting, right? Because if you don't have any disposable income, then you can't really put that towards your savings goals, whether it's immediate savings or home savings or vacation savings or whatever that looks like, right? Great question. So there's kind of 4 uses of our cash. And this is, again, all back to money management. Once you have your budget figured out and you understand what's coming in and what's going out, what you have extra at the end of the month, there's a couple of things that I would tell you you should really focus on. The unexpected is what gets people. So generally speaking, if you're a young family, you want to have 3 months of your living expenses sitting in savings. So when I say living expenses, that means whenever you've added up all your expenses, so let's just say you have to spend $4,000 a month on gas, shelter, food, etc. You want 3 months of that sitting in a savings account. That's $12,000. And some of you might say, well, Melissa, that's a lot of money. I'm like, I'm telling you, it's not when you have, especially if you own a home, if your AC breaks, that's anywhere between $12,000 and $15,000 right now. So there goes that emergency savings. So it's 3 months of your savings that you want to keep. If you have a young family, I would even tell you 6 months, especially if you're a single parent, I would say 6 months. If you're a business owner, I would say 6 months. Now, the closer you get to retirement, you're going to get at least a full years of your living expenses sitting in savings because there's risk management that you need to understand when it comes to your retirement planning. But right out of the gate, just think 3 months, and you want to make sure that you're thinking about the unexpected stuff. Car breaks down, washer and dryer breaks. I got sick. I didn't have health insurance. Oh my gosh, how am I going to cover that, right? So you want to make sure that you have savings in place. The specific short-term savings goals, that's if you know you've got like a medical procedure coming up, or if you know you have to fix your car, it's a couple $1,000s, you want to start putting that into a different savings account. I would say that you want to have a checking account, and then you want to have a savings account. It's easier to separate what your checking and savings is instead of just trying to put it all in one account. That can be confusing. So I would definitely keep them separate. And then for every short-term goal that you have, I would even encourage you to set up a separate account for that. So you have a checking account for your living expenses. That's what comes in and goes out. You have a savings account for your 3 months of savings. And then if you know you have to buy a home or get into an apartment because there's moving costs or whatever, then you put that into a separate savings account so that's, it's separated out and you don't, the tendency with Americans is we see money, we spend money. So if it's all sitting in one account, it comes in, it goes out. And you're like, oh my gosh, I forgot that $1,000 was for this. But if you keep separate accounts, it's actually easier for you to manage and understand this account's for this goal. Make sense? Everyday spending is like what we talked about, groceries, utilities, that kind of stuff. And then again, once you decide what your income minus your expenses are, you'll have discretionary or disposable income. That's where you're going to start putting money towards the future. Okay? Now, there's a couple of ways you can talk about the future. when I work with folks, I tell you, think of 3 different buckets when we talk about wealth management. The first bucket of money is your short-term expenses, everything we just talked about. Everything between now and the next, let's say, 24 months. So next 2 years, right? That's the money you have to spend money on, or goals you have to spend money on, right? And so those should be safe, liquid, not invested in the market. So don't, the craze these days is to put everything in cryptocurrency. You can make a ton of money in cryptocurrency, but you can lose a ton of money. I used to manage cryptocurrency, folks, so please be careful with that. But if it's money you have to spend in the next 2 years, that needs to be in a savings account, super safe, but it should be earning something. I hate lazy money, right? You should be earning at least 4% right now on your savings accounts. If you're not, that's a problem, right? Because that's what most banks are paying. So there are certain banks that are in this area, though, that aren't. And so you need to be looking around for that. Look at your interest rates. Yes, ma'am?
When is it better to put, like, say, for like a high yield savings account? And is that a better choice than just like a regular savings?
Always, as far as I'm concerned. Yeah, if you have money sitting in savings, it should be in a high yield. Yeah.
So is there a difference as far as, like, say you have like a CD, like a certificate of deposit, and it's about to be like that time where you can like renew it or you
Sure.
pull it out? Is it better to just renew or, like you say, move to a high yield savings? Because aren't they around the same as far as interest rate?
Not really. So that's a really good point. So money markets are what they call variable. So your interest rate can move. So the Fed's fixing to hopefully reduce interest rates, right? And so anytime the Fed reduces interest rates, your money market rates and your CD rates will start coming down. You won't lose money, but you won't get paid as much, right? But your money market is variable, which means it's tied to that interest rate. So if they reduce rates, that money markets are going to start coming down. If you have a CD, the rate that you when you first bought that CD, that's what you're locked in at. So that's until it's 6 months, a year, 2 years, whatever that term of that CD is, you're going to get that regardless. Your money market rates will move around a little bit because of if the Fed decides to change rates.
So would it be better if it's going down to just keep the CD because at least that's not going to change?
It depends. So if you've got 3 months of your living expenses, I would still say that should be in a high yield because it needs to be liquid. If something happens, you got to pull it out. You can't be locked in 6 months or a year. If you got a lot of extra savings, like for goals for in a year from now, you're taking a big trip, then sure, put in a 12-month CD. If you've got extra savings to handle your emergency items, right? So it's a play. Most people that will have a little bit of both. It's not all in one. That's really important. Yes. And again, as they start reducing those interest rates, those CDs and the money market rates aren't going to pay as well. We haven't seen money markets and CDs pay this high in a very long time. We've been kind of spoiled with the 4%. Yeah, for sure. Did you have a question, sir?
Well, what she was going to, like, on a CD, since interest rates are going down, is it wise to just take it out?
Well, normally if you take money out of a CD, there's some sort of fee involved. So there's no sense in doing that.
The contract's about to be up.
Oh, I wouldn't roll it over. Is that what you're saying? Okay. Again, it depends. If you don't think you'll need the money for another year, then potentially, because the money market at some point are going to drop down probably between 1% and 2%. But if you can get a CD for 2.5%, sure. I mean, it just kind of depends, right? But that's just something that you'd want to make sure you sit down and talk to someone or go to your banker and talk about, right? It's difficult for me to give specific advice because I don't know your current situation, right? But that's why. So today I'm going to be talking about generalities, but you want to have a little bit of both. You want to make sure that you're talking to your banker, understand your upcoming living expenses before you can say, yep, this is exactly what I should do, right? Makes sense. Auto pay is a big thing. So there's a couple things that will change your life when it comes to money management. The first thing is know where every dollar comes in. So every dollar comes in, it's going out, everything's earmarked, you know exactly what you're spending your money on. If you can get that, that's fantastic. The second is make things easy for yourself. So again, as Americans, we see money, we spend money, because that's the way it's just our culture, right? So the money comes into the account. Every time you get paid, you can set up direct deposits, whether it's through your payroll system or through your checking account. You can make sure that if you know you want to save $200 a month into your savings or into any of your goals, make that automate it. You're too busy, you're not going to remember to do that monthly. You're going to look up in a year from now and you're like, oh my gosh, I forgot to do all that, right? So make it automated. Most major banks these days, haven't seen one in a long time that don't have this functionality, is where you can do automatic into savings, automatic into investments. It's very easy. If you don't know how to do that, go online, check it out, or again, go see your bank, go see your investment person. That's super easy, but that is a great way to make sure that you stay on track with your goals, and it's super easy. The unexpected stuff we talked about, home repair, auto repair, It will happen to you. Everyone says it's not going to happen to me. It will happen to you, absolutely. So please make sure you're planning for that, especially medical expenses. Medical expenses is one of the top reasons for bankruptcy in the United States. It's super, super expensive. And if you're an individual like, oh, I'm not sure I want to pay for health insurance, you want to pay for health insurance. It's super, super important. And that's one thing, getting back to making sure everything's gone up these days, is health insurance has gotten really expensive, but it's super, super important. It's far cheaper than going in and not having coverage. Yes, sir.
So how would you recommend we go about finding a good health insurance that's reasonable in terms of cost and good in terms of benefits?
I mean, they have the Obamacare that you can go on, and based on your income, you can get them based off that way. And then if you have a little bit like a special need, or if you've got like a pre-diagnosis with a certain health issue, you can actually use a health insurance agent. I'm a financial advisor, but I also have my life insurance and health insurance. I don't like health insurance, so I refer out. But there are all sorts of agents in this area that can sit down with you, look at your medications, look at what you've been pre-diagnosed with, and make sure you get on the right plan, and that you can keep your doctors, and that you have the right prescription coverage. So it's all about, if you feel comfortable and go out there and read all the health stuff, not everyone is, I would just use an agent. There's a lot of agents that will talk to you without charging you anything. You don't have to pay for that. They'll sit down and talk you through it, for sure. On the Medicare side, the same thing. For those approaching 65, it'll be really super important that you look at what type of supplemental Medicare plan that you have. Medicare is actually better than what most people think, frankly, and it's not going away, regardless of what the media says. So don't get too worried about that, okay? Build your reserves, that's a big one. Again, that's always just talk about constant focus on savings. Look, I work with a lot of people with all types of goals. I can do complicated retirement calculations all day long. But the thing that frustrates, the one goal that frustrates them the most is savings. Because you build it up and then it goes right out the door. And you build it up and it goes right out the door, especially if you have kids. And you're just like, I feel like I'm constantly chasing that thing. And it's because you are. That's what it's there for. Your savings is your first line of defense when it comes to your wealth plan. Because if you have savings and you're using that and you're not going to credit card debt, debt will mess up your plan in a second. So please don't get in the habit of getting yourself into credit card debt. It's just this snowball that you can never get off. This just revolving circle. And if you're there, it's okay. We can fix it. It's going to take a lot of work, but we can fix it, right? So, and frankly, everyone goes through life in their experiences. There will be some point in your life, if you haven't already been there, where you're going to have credit card debt, or you're going to have a lot of debt, and you're like, oh my gosh, how do I get out of this? It just happens because of a medical expense. Sometimes it's our own fault, sometimes it's not, right? And so you just have to pay attention to debt. Again, we talked about separating your checkings and savings. Sometimes people try to put it all together. If you own a business too, your business should be completely separate than your personal. Please, your CPA will love me for saying that. But definitely, you want to keep everything personal separate from your business. It needs to be completely separate. Don't intermingle business and personal expenses. That's a big no-no. And you don't want to be audited by the IRS. Sources of investment, well, we can talk more about that if we have time. So I wanted to talk about debit cards and credit cards. So me personally, I do everything just like the gentleman was saying a second ago. I put everything on my credit card because I get miles, and it's very rare that I pay for airline tickets. But I am super disciplined. Like, I never carry balances. It gets paid off every single month. If you're not disciplined, do not do that. Don't get caught up in the reward game and, I'm saving more money by paying a little bit more interest over here, and I'm going to get a free airline ticket over there. Like, just don't get caught up in that, right? And so just be very disciplined. If you don't think you can pay it off, then don't put it on your credit card. I will tell you that from a protection per se, using a credit card is actually a little bit better than using a debit card. Because if you get hacked or someone gets a hold of your debit card, that money's coming right out of your checking account. Right? If a credit card, you can actually go in and say, hey, I didn't do that, and you have protection. It's not coming out of your bank account. So there is a lot more protection around credit cards than there are with debit cards, so just be mindful of that. And please, please, please do not put your debit card in any online shopping. That is the quickest way to get hacked and for your money to get sucked right out of your checking account. If you're doing that, stop immediately, change your passwords, stop. I deal with a lot of fraudulent issues where my clients are getting stuck in, not because of Edward Jones, but it's because their bank got hacked or they got tricked in some sort of fraud or scam, and it's because they've either shared their debit card information or they're using their debit card for online shopping, and you got to stop that. Yes?
How is
attempts of fraud or people trying to fraudulently get money from people rising rapidly? Because over the last year or two, I mean, personally and from a few friends I've had, it seems like that's been increasing, like at least in terms of texts, emails, or saying I need to pay for this, or government wants money for something I allegedly did.
Tolls is the recent one. Who's gotten that one? Yeah, it's because everything's online. It's drastically increased, I would say, over the last decade. Prior to coming to Edward Jones, I actually ran a large clearing firm in downtown Dallas, which is a fancy word for a large bank plus investment firm. And we had all sorts of hacks and schemes that our clients would get involved with. Right now, a big one coming up, by the way, is Medicare. There's a lot of misinformation and fraudulent scams around Medicare, so just be careful. If someone sends you a text or an email and you aren't expecting it, don't open it, don't click it, right? Don't put yourself in a position where, oh, I thought that would be okay. So please don't do that. Don't ever open a picture, don't click on a link, nothing like that. It'll keep yourself from that.
Is there any discussion of government trying to regulate attempts by fraud to make sure that people are held accountable for attempting it?
It'd be great. The problem is that a lot of those scams are happening actually outside the United States, where they're coming in abroad.
If they're happening outside, they don't fall under U.S. jurisdiction.
In some cases. And frankly, it's just hard to find the people. The dark web and whatnot, they do a really good job of hiding themselves, and so it's just very difficult to unwind. So the best way to protect yourself is don't click on anything. Don't click links, don't open pictures, right? And certainly if someone's calling you, like my mother-in-law, she's 84, she gets called all the time. One of the big things that's going around right now is they'll call seniors and they'll tell them that their grandkid just got into a car accident and they have to immediately send money to help them get help at the hospital. That's happened to my mother-in-law at least 3 times in the last 2 years. And there's one going around with toll roads. Whenever IRS starts coming up, the tax season, you're going to start getting a lot more IRS fraudulent scams. And so it's just that kind of the way of the world these days, unfortunately. But the best way to protect yourself is, if you don't know the number calling you, don't pick up and don't click on anything. Don't open any emails, don't open any texts, okay? The other thing too is you can actually go in and freeze your credit. So I did this years ago because, again, my name is Melissa Miller, my husband is Jason Miller, and there's about 1 million Jason Millers probably in the DFW, right? And he gets hacked all the time. And so when we first got married, someone stole his information and tried to open a bank account. I'm like, okay, we got to stop this. And so I immediately froze all of our credit. So you can go to every single credit bureau, so Experian, TransUnion, et cetera, and you can freeze your credit. What that means is no one can open up like a bank account or a loan or anything in your name without you unfreezing it, which can be a little annoying, especially if you're trying to go buy a car. You're like, okay, I can't buy it today. I got to go home. I got to unfreeze my credit. Let me open up my credit so you can run your analysis, see if it'll qualify me, and then you have to shut it back down. But frankly, it's probably going to slow you down to making large purchases anyways, and you don't need to be making those purchases that quick either way. So freeze your credit. That's another really good way of protecting yourself, and it's free. That doesn't cost you anything. Just go out to each one of those websites, freeze your credit, and you're good. That's another big way. I do that for all my kids. I've done that for all my in-laws, grandparents. Everything's frozen. And sometimes they're like, Melissa, you froze my credit. I'm like, sorry, you're protected. I'll unfreeze it. Any other questions around credit cards? Yes, ma'am.
So say you're about to pay off your credit card and stuff like that. I'm not really sure what my current interest rate is. Should we if we pay it off, it's at 0, our balance is at 0. Should that be a time when we try to see if we can get a different rate, or see if we can, or if that's not something?
It's very difficult to get the credit card companies to reduce their interest rates because it's all based off what the Fed does with their rates, frankly. If you have a credit card right now, you're probably paying over 20%, unless you've got some sort of credit card where you've had it for a very long time and you've got some agreement with them. But most credit cards right now, you're paying probably 22 plus, which is insane, right? And so that's why I don't carry balances. You got to stop doing that, right? But to this point, and this actually is required by law now. They didn't used to put this on your credit card statements, but on every credit card statement, you should be able to see what your balance is, your monthly payment, and your payment due date. But what they added is that they're showing you that if you only pay the minimum payment, you're going to pay on that for 8 years. So you end up paying, $17.86 versus $27.85. But if you put a few dollars extra, instead of just putting $53, you just add a few dollars extra, that 8 years goes to 3 years. Look how much you save. just by a couple extra dollars. It's compound interest. Compound interest is fantastic in the investment world, but it can kill you in the debt world. It's the same concept, right? So just by a few extra dollars, you can seriously start paying down that debt. Yes.
So how much do you recommend putting on auto payments for your credit card? Because effectively right now, that's what I do, and I effectively treat my credit card like a debit card if I don't spend any more than I need to.
That's what I do, but you have to be disciplined. As long as you're not carrying balances, I'm saying it's okay. I'd rather it go through your credit card because, again, if someone hacks your information and starts coming out of your checking account, you're going to have to go fight with your bank to get the money back. And that's not always easy, and you don't always get it all back. I'm just telling you that right now. I've had several clients that have their bank accounts got hacked, and the bank will not honor and put the money back into their account. So just be very careful with that. Yeah. So this is super important. So let's talk about debt management real quick. So a lot of us will have multiple credit cards. Like I'm the fan of like you might have 2. If you're a business owner, maybe 3. Like you shouldn't have 8, 9, 10. That's not helping you, right, when it comes to your credit score. So have 2 or 3 that you're really good at keeping. I prefer 1, frankly. If you don't have any dependents and you aren't really doing anything, one's enough. But that will help you build your credit score because we all need credit scores. It's the world we live in, right? That's going to help you go buy a car, a house, etc. Right? So, but keep 1 or 2 credit cards, preferably 1. But if you have multiple and you have a lot of debt, let's think of it this way. The quickest way to pay that down, there's two different philosophies. One is called the avalanche. So you take you list out all your credit cards, you put your highest balance with the highest interest rate, and you just list them all out. After you've made minimum payments on all your credit cards, because you always want to make minimum payments or you'll get yourself in trouble. Always make minimums, right? But anything extra, so again, you've done your budget, you know what you have extra at the end of the month, anything extra, you put to the largest balance with the largest interest rate. Financially speaking, that's the best way to pay down debt. Once you get that one paid off, you go down the next one. Get that one paid down, you go to the next one. That's called the avalanche approach. Financially speaking, that's if you're looking at just pure mathematics, that's the best way to go it. Now, some people are like, I need to win. It's like psychological. Like my husband would be in this category. I got to have a win. If I've got multiple debt, like I'm going to start with my smallest one, and I'm going to get that one paid off. I'm going to feel great about it. I'm going to get motivated. I'm going to go to the next one. Go there too, because if you're looking at mathematics both ways, avalanche will save you some money, but I'd rather you do snowball and actually get it done than get frustrated at avalanche and never do it, right? Because if you need a win, start with the smallest balance, lowest interest rate, just to get it off, just so you can get some motivation to do it. The biggest thing that will kill you financially going forward is debt. Don't do it. If you're in it, let's figure it out, right? Everyone can get through it, but you've got to be very strategic and intentional with it. Yes, ma'am.
Oh, okay. I have another question.
I'll come back to you.
Okay, say like you have $1,000 in like credit card debt.
Mhm.
You know you have in your checking account more than that, and would you say it would be better to just go ahead and pay that one, like go ahead and get it done, like pay that $1,000? I know it won't necessarily hurt me. I mean, because I know I have like enough money in my checking account to like support me if anything happens. At that point, I just don't technically want to pay $1,000 right now. You know what I mean? Towards that, but I know if I did need to, I could. Would you say just go ahead and pay it and just be done with it?
Generally speaking, if you have enough to cover your living expenses for a couple of months, then I would say go ahead and pay it off. If you have dependents, I would still tell you to keep that money in savings, because if your kid gets the arm breaks, something like that, all of a sudden you have this unexpected expense and you're going right back on debt, right? But if you have enough in savings and you're comfortable with from the living expenses and you know that you're not going to miss that $1,000, then pay it off. Because you're paying interest on it. Why would you pay interest on it, right? Yes, sir.
Oh, never mind.
You sure? Yep. Okay. Any questions about snowball and avalanche? Oh, I'm sorry. Go ahead. Yeah, sure.
I understand what you're talking about the number of credit cards.
Yeah.
But what I've heard is for like some accounts that I've had a long time, they may carry like a zero balance right now. I don't want to get rid of it because I heard that it will ding my credit if I get rid of some of my old.
It can. It can, absolutely. It absolutely can. So if you've got several credit cards and you're like, okay, well, which one, if I don't need 10, maybe I need 3 or 4, right? You don't want to make a practice of going to the one that you've had the longest. Credit history is super important when it comes to credit scores. So if whichever one you've had the longest, that's the one you tend to want to kind of avoid shutting down. But I wouldn't just go home and say, okay, Melissa said get rid of all of her credit cards. I'm not saying that. You need to, again, be strategic, right? Because it will impact your credit score. If you go in and just like, I'm turning them all up, I'm shutting them all down, it will absolutely impact your credit score. And so again, that's why it's always good to have a conversation about, okay, how do I manage this? What's the best way to approach it? Because I can't necessarily cover every detail right when I'm up here talking to everyone, right? But that's super important. Thank you for mentioning that. Is the credit history is important. Absolutely. Yeah. Is there any other questions on debt? Okay.
I think, just a side note, one of the scams of, those debt relief companies,
Yeah. This clicker's not working.
the clients to stop paying everything.
Yeah.
Those are disastrous, and I think
They can be.
These things.
Yeah, so there's a lot of debt consolidation companies out there, and look, I'll be honest with you. There are some ways you can consolidate debt, and some of those companies are very reputable, and they've helped out some of my clients. So I'm not saying they're all bad. I'm just saying know what you're getting into. And so whenever someone tells you to stop paying your minimums, it should be a red flag because that's going to destroy your credit. You should always pay your minimums until you know you fully consolidated that and that everything is taken care of. And again, there's some nuances to that, so it's kind of hard to explain all the details there. But to your point, if someone's approaching you about debt consolidation, just be very careful with that. I have a lot of people will call me and ask me, like, Melissa, should I take a home equity line out and pay off my credit card debt? Potentially. It depends. How much equity do you have in the house? Is that your forever home? Is it, what rate can you get on your home equity line? Normally you can get between a 6 and 8% right now on your home equity line. It's better than 25% on credit cards, right? So there's ways we can explore how to pay down debt. There's not going to be one magic answer for everyone's situation because everyone's situation is different. Make sense? Yes, sir.
Can you use your life insurance to pay that?
I wouldn't. Yeah, the reason why I would say that is because your life insurance, frankly, is to protect your family in case you were to pass away. So if you're taking money out of like a life insurance policy, if you were to pass away, they're going to pay off what you borrowed against it, and then your family gets the rest. And so that, to me, that would be like a very last resort to use your life insurance. I've had some clients do it against my recommendation, but that, to me, that's a very last resort. There's other ways we can figure it out. Absolutely. I wouldn't do that because your life insurance is what I call your tax-free legacy to your family. You pass away, oh my gosh, it's a catastrophic event, they have to have something to live on. You don't want to give them less just because you end up using it to pay down debt. And frankly, in most cases, not all, please hear me, that's my disclaimer. If you have debt, your loved ones aren't going to be responsible for it unless they're joint owners or signers on your debt. A lot of people think that, because I have a lot of retirees, and one husband passes away, the wife thinks like, oh my gosh, he racked up all this credit card, I had no idea. She's not technically responsible for it unless she's on there as a co-signer as a joint credit card. That's his debt. So in Texas anyways, the rules change in different states, right? But in Texas, that's the way it works. So again, that's my spill on don't rob your life insurance policy.
What are states that don't have it like that?
They're more West Coast, can I say that? Without upsetting too many people. And I have clients all over the country, so I will say they're just know your state and what you're in is all I'm saying. I'm not sure who's listening to us, so I don't know if we're all in Texas or if we're in other states. So, but East and West Coast can be problematic. Every state has their own rules. That's super important. So if you think about you're moving to a different state, like Louisiana has some crazy inheritance stuff going on over there. So you have to understand each state that you're moving into because they may have different estate taxes, they may have different inheritance taxes. You may pay, because in Texas we don't pay state income taxes, but a lot of other states do, which could significantly impact you. So you have to pay attention to all that. Absolutely. I must have left it on there too much. So we talked about the link of credit history, types of credit used, research credit. So you guys know you can get your free credit. Please don't pay for credit reports. Like you can get your credit report at myfico.com. You don't have to pay for a credit report, but you should get in a habit of maybe looking at that at least yearly, because you want to go out there and see if people have if you haven't had your credit frozen, you want to go out there and see if people actually have opened up stuff in your name. That's super important, especially if you're looking to buy a house. You want to know what's on your credit report. If you're looking to buy a car, you want to know what's on your credit report because that's all going to impact your interest rate, which is going to impact your monthly payment, which is going to impact what you're going to pay for that car, the house, the pool, like whatever you're looking to buy. Okay. Here's your credit bureaus. Again, you can go out, there's that creditreport.com. The Equifax, Experian, TransUnion, those are the major credit bureaus. Those are the ones, if you go out to their websites, you can freeze your credit. Okay.
Experience now makes you pay too much of your credit.
Not me. No, so you do the basic credit freeze. They try to get you to pay for that subscription. You don't have to do the subscription to freeze your credit. Freeze your credit, yeah. Yeah, absolutely.
What's a credit freeze?
It prevents people from opening up your, so for instance, we just recently had to buy my aunt a car. And so she needed help. I have all our credit frozen. And so when we went to the dealership, they're like, well, we've got to pull your credit to see what interest rate we're going to get you. Well, I had to go home. I had to unfreeze my credit. Then they could pull my credit, run it. So no one can go in and just start tagging my credit. Because the more inquiries into your credit, the lower your credit score drops. And sometimes people will say, well, Melissa, what's a good credit score? I mean, normally to buy a house or something major like that, you're going to need in the 600s at a minimum. And that's not going to be a great interest rate. You really want to be like in the high 7s, 8s. That's your goal. But if you're like in the 4s and the 5s, it's okay, get to 6. Like this is make one step of improvement. Okay? And frankly, when you're right out of college, you may not have a credit score. You don't have any credit, or you don't have anything in your name. So your big thing is like whenever you move out from your parents' home, you want to start getting utilities in your name. You want to start getting the car payment in your name because you're building credit so that you can actually go and buy a car in the future or a house in the future. A lot of times that hurts the younger generation because they don't have any credit history and they can't go out and get their own cars and houses. Parents are having to step in and co-sign because of that reason. Yeah. Talked about this stuff.
I mean, as a parent, adding your kid as a co-person on your credit card or no?
I don't do co-signer, authorized signer. Yes.
So they can build credit even though like you're a teenager and obviously.
Yes, I did that for my son. Yeah, recently we bought our house. So in my family, what we do is we say, well, we'll help you pay for your first business, your first home, or we'll pay for your college. That's what our kids have the option for. And so my son was like, well, I'm going to go into plumbing. Well, he came here for a couple of years to get his associate's degree. He's going to go in trade school now. He wants to buy a house. I'm like, okay, we'll help you. Well, I wanted him to have it. I wanted it to be in his name, right? But he didn't have any credit because he's young, right? And so we actually added him as an authorized signer to my credit card. He had a credit score within 30 days, and bam, he was able to get it under his. And frankly, I didn't have to put that much money down. As an investment property, I would have had to probably put $60,000 to $70,000 down. But because he bought it in his name, I only had to put down $8,000.
And that's because he was a first-time home buyer?
That's right. Yep. Yeah, first-time home buyers have a lot of down payment assistance these days. And look, the mortgage companies and the realtors, they know the interest rate's high. So there's all sorts of assistance when it comes to getting into a home. Please don't get into fixed arms. That's what happened. That's what blew up 2008. Like you want to get a fixed interest rate when it comes to your home. Don't get in variable arms. Excuse me, I said fixed earlier. Don't get into arms. Yeah, please don't get into arms. Your arms means that your interest rate will actually go up on you. And that's what caused the financial crisis in 2008. I don't have time to get in that. If you want that story, I'm happy to share it with you. Yeah, don't do variable or arms on your home. That will price you right out of your house and you won't have a house anymore. So fixed. Okay? Fixed means that you lock in that rate and it's there. Variable means it can move on you. That's what that means. I know sometimes I use financial terms and not everyone understands that, but please stop me if you don't. Okay, we talked about that stuff. Okay, I think that's it for the most part. What other questions do you have? Yes.
Say you have like a side hustle referee. Would you recommend creating a business for that, or just leaving that as like a slave? Because I have troubles when I fill out my taxes.
It depends, honestly. Like, depends on the amount of income you have coming in.
Say for instance, like $5,000 max a year.
I would tell you to talk to a tax person, but probably not. Yeah. Normally, when you start getting into like a small business or like a separate income stream, all the CPAs that I've worked with in the past have told me that it needs to be, 15, 20, 30,000.
A question about the auto pay. You're talking about obviously using the debit card and the credit card for an auto pay. There are some entities that only give you the option of using a bank account that in many cases is tied to a debit card as well. Are there any strategies there? Just find a different entity for what that?
Yeah, that's going to be pretty rare these days, but they're out there. right? So in cases like that, depending on how big the payment is, like I would probably create a separate account that would only be tied to that. And it's me coming from 25 years of experience and seeing like worst case scenarios, and so I get super sensitive about fraud and people. Like I've had a lot of clients, their bank accounts just get emptied overnight, like it's insane. So yeah, if for some reason that institution is requiring you and they won't take a credit card, then I would just say, okay, well then you can take it out of this specific account, and I will put money into it each month automatically, so the money's there, and I'm not going to deal with it. That way, all your other assets are protected. Is the way I would work around that. It's a little extra work, but it will protect you. Yeah, great question.
You know what's a scam? Paying rent with your credit card. And they charge you a fee to use your credit card. And
Yeah.
you go in there with a cashier's check.
It's not just rent, actually. A lot of vendors, institutions will actually pass on that credit card fee to the purchaser now. That didn't always used to be the case, but a lot of people are doing that, especially contractors. Contractors, if you pay with your credit card, they'll put 2 or 3%. They're passing on that credit charge onto the consumer as opposed to them eating it. A lot of companies used to eat it, honestly. And it's not really their problem. It's the credit card companies. Like, why are you charging them 2 or 3% to use your credit card? So it's the credit card companies being a little too greedy, in my opinion. But yeah, I mean, the small business owner or whoever you're doing business with, if they can't afford to absorb it, then they're going to want to pass it to you, right? Now, if they're increasing it above what they're being charged on the credit card, then I don't know that's their own issue.
It's like, well, we don't take cash, just cards. I'm like,
Yeah, there's a lot of institutions these days that don't take cash anymore, which is unfortunate. Yeah. Any other questions? I know we talked a lot about budgeting, debt management, anything. How much time do we have? Do we have a little extra time for anything else? Okay. I talked about we've got a ton of people moving into the area around outside of Texas. Say it again?
Northern Collin County and southern.
Oh, sure. Yeah, and it's causing all the home prices to go up, right?
Uh-huh.
Yeah.
And then, well, a lot of rental units as well.
The same too, but kind of the idea is like making your money go longer. Your property taxes, if you guys own a home, you should be appealing those. I personally don't take the time to put all the documentation and going down the county and fight them. There's a company out there that if they can get my property taxes reduced, then I pay them a percentage and I'm out, right? But they don't get paid if they don't get my property taxes reduced. So they do all the legwork. So I'd rather give up a couple $100 for them to go do all the heavy lifting and me to say, okay, did we get it reduced? If not, then okay, we'll try again next year. Yes, sir.
When you're looking to open a savings account with your bank, what would be some things you should keep in mind before you go there, or when you're talking about it?
I mean, a lot of banks these days will charge you fees. Oh my goodness, I don't understand that. They're charging you to hold your money. I don't get it. So just be careful with minimums at any bank. Just be careful with bank minimums, right? And so, like for instance, I bank at Wells Fargo, and I know that I think if I drop below 20,000, they charge me some sort of stupid monthly fee, where I think they charge me $25. Exactly, like maintenance for what? I don't whatever. It's just a way of making money. Honestly, that's what a bank does. That's their job. They're not a nonprofit, right? And so just be aware of your minimums, because you don't want to get charged fees for savings accounts or checking accounts. That doesn't make any sense. There's all sorts of different options out there that you don't have to deal with that. But there are quite a few that banks that do that. I will say, I'm a fan of banks. Like, I think you need a relationship with the bank. I'm also a fan of like local credit unions. Credit unions are fantastic partners. They care about you more. And they actually usually can do a much better job with auto financing, credit unions can, than a larger bank or even your dealership. So I personally have a relationship with Wells Fargo, a major bank, and I have a relationship with EECU, which is a local credit union. And I do all my auto financing through EECU. They do a really good job. Yeah, so again, those are kind of things that just ask questions. A lot of times we make bad financial decisions, and it's not because we intentionally wake up and say, I'm going to make a bad financial decision today. It's just we don't know, right? We don't know what question to ask. We had no idea what the other options are. So just ask questions. That's where a lot of my clients will use me as a sounding board. Like, hey, Melissa, what do you think about that? Should I lease? Should I buy? Should I rent? Should I whatever? I'm like, I don't know. Let me run the numbers, right? And so it's always good to have someone that you can just sanity check, right? It's always good to have someone in the corner from that regard. So before we close, I want to make sure you guys know that we do have.
Worst case scenario they can share with us?
Oh, on which side? Oh my goodness. Life insurance, what? I will tell you that So I'll cover this and I'll come back to your worst case scenario because I see all sorts of stuff. So this is a website, wisdom.edwardjones.com, and it's actually in your packet. It's your second page of your packet. It's actually a free resource. At Edward Jones, we're huge about education, which is why I take time out to do stuff like this, because I'm big about education. Because I'm a finance major, and frankly, most of what I talk about and work with my clients on, it wasn't taught in class. It wasn't taught in college. At least it wasn't back then. Granted, I'm a little bit older than most people in here, but I'm just saying. But this is a really cool website. So when you're going onto this website, there's all sorts of free videos out here that you can check out, and it'll talk about money basics and savings and budgeting and smart investing and dealing with debt and home ownership and financial caregiving and retirement. There's like little videos for each one of these. That reporting for financial elder abuse and how to become a caretaker. There are little quick videos out there that you can actually go out there and educate yourself, right? And knowledge is power, but only if it's applied. So it's a really great website. It's a free resource. Check it out. And it covers everything for the basics, right? I would say one big caveat when it comes to worst case scenarios. There is a lot of misinformation on social media platforms these days, regardless of what topic we're talking about. So we're talking about financials, right? And so we do a ton of industry studies, not just Edward Jones, but the industry at large. There's a lot of studies on, okay, if you're out on social media platforms like the TikToks and the Instagrams and the Snapchats and you name it, whatever flavor you're involved in, okay? I would say this. They've done a study on that, and over 50% of the content that's financial advice content that's out on social media platforms is either outright wrong or they're not giving you all the information. So if you're listening to a TikTok person or if you're listening to whatever influencer you're listening to, they're not licensed. They have no accountability to what they're telling you. And so they can say pretty much whatever they want and they'll never get in trouble for it. So I would tell you that if you're going to be working with someone, please talk to someone that's licensed. Like I have licenses, every Edward Jones advisor has licenses, but whenever you call companies, just because they say they're a financial professional does not mean that they're licensed. Please understand that, okay? So please take your advice from people who are licensed. Like I'm held accountable. I could lose my licenses. I could lose my livelihood if I give bad information. I'm actually considered a fiduciary in some capacity, in that if I'm required by law to act in my client's best interest, so I have a higher level of standard, so to speak. So please talk to people who know what they're doing and they're licensed. Some of the biggest horror stories is people getting caught up in stuff they had no business being in. There's a lot of talk about, look, if it sounds too good to be true, it's too good to be true. If you can make $2,000 a week, you can lose $2,000 a week, right? So anytime you get into investments, your number one question always, any financial goals, whether you're putting money in the stock market or into a house, your biggest question should always be, what's my risk? What's my risk? How can I lose money? How can this negatively impact me? Those are the questions you should be asking, because you should never move forward if you don't truly understand every risk that you're taking. That's where you're going to get yourself in trouble, is not understanding the risks that you're taking. Because look, everyone likes to make thousands of dollars a month. But if you're not prepared to lose thousands and thousands of dollars a month, then you have no business being in that. There's a lot of talk about oil. We're in Texas. A lot of, seems like clients out in West Texas get caught up in these oil companies where they're like, oh, we guarantee a 20%, give me $100,000 and we'll give you a 20% rate of return, guaranteed. There's no guarantees in the investment world. So if you hear guarantee, it's a red flag, red flag, red flag. So if you hear stuff like that, your antennas should go up. Right? So please understand that. And there's no such thing as no commission. There just isn't. There isn't a nonprofit financial firm out there. They're in business to make money. So if they tell you they're not charging you fees, they're getting you some way. There's some sort of fee involved, right?
Or the other party.
That's right.
They're paying them.
That's exactly right. There's always a cost of doing business. So please don't walk into any company thinking you're not going to get charged something. And you need to ask, okay, well, what are my fees? So at Edward Jones, we'll walk through, okay, here's exactly how this account's going to be charged. Here's exactly what this investment would cost. You need to understand that, because that actually will impact your rate of return. And that's what you care about. You're trying to make money, right? Any questions about that? It's a great resource. Check it out. And I will stick around a little bit longer in case someone has a personal question they need to answer to. Thank you so much for your time. I know it's been a while, and it's not always easy to talk about finance for 45 minutes to an hour. So, thank you. Of course.
Excellent topics, excellent experience. We truly appreciate your presence.
It's my pleasure.
Thank you so much.
Yep, you bet.
If
Thank
you
you.
came in late and you get a chance to do the sign-in, that's there on the left. If you'd evaluate what you heard today and let us know how you heard about us,
Thank you.
we'd appreciate that so we can make sure we're giving you what you need.